Hey everybody, this is John and welcome to my YouTube channel, Retire Well. So right now it's July of 2022 and the Fed's been steadily increasing interest rates trying to combat inflation. It might be a good time to be looking at the concept of tax-free municipal bonds. If you're otherwise a CD buyer, you have bond funds, you have bond ETFs in your portfolio, municipal bonds are tax-free because they benefit the public good in some way. Think about like tollways, school districts, airports, state of Texas, state of California, you name it. There are many municipal bonds out there and they are federally tax-free. And so it could be a good deal for you. It just depends on your tax bracket. The higher your tax bracket and you're not paying federal tax on that, the better a deal it is for you. And so I want to show you a little exercise that's called taxable equivalent yield. And this will basically show you how good that benefit is to you based on your tax bracket. I just want to add that when we're talking about tax-free municipal bonds, we're talking about safe investments, but no investment is 100% safe. You can lose money in any investment, so you should talk carefully with your financial professional about that and make sure that's suitable for your level of risk. So I pulled a sample bond portfolio here, and this is not to represent anything that's currently available. This is just a sample bond portfolio that's out there. And so you'll see there in this intermediate strategy or this short-term strategy, it's about 2.5 year duration, but the current yield is currently around 3.7%. So 3.7% means that is tax-free income to me, based on if I invest in this bond portfolio. And so how good is that to me? Okay, so if the formula for taxable equivalent yield, you take the yield and it's like a fraction over 1 minus your tax bracket. Okay, so what we can break that down, let's take somebody that's in the highest tax bracket, which is 37% currently. So if I take that current yield that I saw, which is 3.7%, and I put it over 1 minus 37%, and let's break that down a little bit further. So the exact formula would be 3.7 over 1 minus 0.37, which gives us 3.7 over 0.63. Back to math class here. And so if we crunch that number, we come up with 5.87%. That's our taxable equivalent yield. So what does that mean? That actually means that if I was to go buy a CD at the bank, if I was looking at a bond fund or something like that, like a taxable, CDs are taxable, bond funds are usually taxable to you, I'd have to find one that's at least 5.87% yield to be as good as this tax-free bond that's paying 3.7% because of my high tax bracket. So that's a pretty good benefit. That's the taxable equivalent yield. So let's even look at it on the other extreme. What if I'm in a low tax bracket? Is this still a good deal for me? It might be. So if we take that same example, 3.7% over 1 minus 12%, that's the lowest tax bracket currently, and then we crunch that number 3.7 over 0.88, actually what we come out with is about 4.2%. That's our taxable equivalent yield. So if I'm in a low tax bracket, a 12% bracket, and I'm looking to buy fixed income and I may go to the bank, I'm looking at a CD, that interest is going to be taxable to me. So I'd have to find a CD that's paying at least 4.2% to be as good as that tax-free municipal bond portfolio that we looked at. So it's something to think about. It's not for everybody. I should also point out that I'm not a tax advisor. I'm a financial advisor. So you should always consult with a professional tax advisor before you make decisions like this on what to invest in, tax-free bonds versus taxable bonds. They could have certainly implications to you in your tax return. If you have any questions for me, my contact information is in the About section of my YouTube channel. Feel free to reach out anytime. If you have a suggestion for a video, please let me know. So thank you for watching my video.